Welcome back. We're going back and looking at the market, which for today is having a bit of a consolidation day continue. Amit Khurana of Dolat Capital is with us now to talk about the road ahead. Amit, good to have you on the show. It's almost become a habit, right? New highs on a daily basis. So it's good to actually see some quiet days and some consolidation. But really, I mean, how are you looking at the overall construct and the setup right now? We're running into earnings season. Expectations are high, and so is the market.
Well, yeah, I mean, you get days of consolidation, which in a way become pseudo corrections in the bull market. I mean, one wishes there were some corrections across, the wider section of the market, but that doesn't seem to be the case. And we were expecting some correction to play out, but it doesn't seem to be in the offing. And every intraday dip is being bought into. Uh, so, if you look at the earnings perspective, I think earnings will be probably one of the better ones. The larger trajectory seems to be pretty supportive, and therefore that has been one of the reasons that the market has kept sort of pretty strong levels, so to say. Whether we will get upgrades in the earnings, I think it's early days to talk about it, especially some of the critical sectors, whether they'll be giving it enough fillip to get an earnings upgrade and justifying this kind of a move. But largely, our narrative is that bottoms up is the way to go about the second half of the calendar year. I think the index returns, even on FY26, now seem to be in the fair sort of zone. And any meaningful upsides from here over the next 3 to 6 months look pretty, challenging and difficult to justify. I mean, we're ballpark looking at about 1280 to 1300 rupees of EPS FY26 numbers. So you're looking at almost 18, 19 odd times, which is not too expensive, but definitely not cheap from an entry point of view. So bottoms up, sector rotation, and more of a tactical plays is how we are positioning on the market and building in muted returns on the nifty for the next the remaining part of the calendar.
Amit, I was reading the latest note from Dolat Capital you all have done. You've gone back and looked at the historical numbers, and you've said that we haven't seen a 10% plus correction in the market since July of 2022. That's 24 months in counting, and we haven't seen a significant fall in our markets. And you also go on to say that the Indian equity valuation remains expensive versus bonds, and that also perhaps explains the FPI action. Now, even Indian debt bonds are available, and that is an attractive option for them. But let's get to the specific sectoral calls and the portfolio recommendations that you have. I want to start with banking. On the whole, you're neutral on banks, but you like Kotak Mahindra Bank, where there is that regulatory overhang. And the other one is HDFC Bank, where fundamentally they appear to be struggling, particularly on the deposit front. The dip that we're seeing, is it a buying opportunity? And what explains this rally from 1450 to that 1700 that we saw in the recent past?
That was clearly a tactical rally because of the expectations of MSCI weightage revisions and potential headroom for fresh buying. And I think that largely played out. But I think the predominant theme there has been the performance, which again has been short of expectations. And I think the challenge for HDFC as a franchise continues to be, getting the deposits in place. And unless they can get that act together, it's difficult to sort of build in very, very big upgrades on earnings. The market has been expecting that ever since the merger got announced, but that has not been the case, and therefore the level of de-rating. But all said and done, I think fundamentally the franchise remains pretty strong, and eventually we expect it to catch up. And same play for Kotak. I think these are two banks which have largely underperformed the banking space. You've seen significant amount of re-rating in all the other franchises, and our take was largely driven by the fact that they will catch up on their performance. Unfortunately, the earlier reports on the pre-earnings reports doesn't seem to be supporting that hypothesis, but we remain aligned to our thought process that over the next 12 to 18 months they will catch up on their performance. So banking is more of a neutral mode because of the fact that most of the other franchises have sort of got re-rated very materially, and therefore we took a step back and went positive to neutral.
Okay. Amit, we want to get Dolat Capital's view on discretionary consumption. So I'll allow you to sort of gather your thoughts for a minute or two, because that's one pocket that's been the strongest in the market, right? And now the debate is whether the tilt is going to move towards staples, to rural consumption. We've started getting the update. So I thought this is a good time to act to Amit now. Amit, so that's the question, right? Do you still keep playing discretionary consumption? If yes, do the jewelers still make the cut? Do the valuations still leave something on the table?
Well, that's the challenge. I think Titan is one stock which we cover in the sector, very richly valued. We like that structural basis, but near term, we believe there is some type of consolidation. And Notably, in our channel checks, we are finding the local players now far better competitive versus Titan. So Tanishq is facing its own challenges in terms of trying to manage this local competition. But it doesn't take away the fact that India is a large market, and over a period of time, these valuations will get justified. But if you ask me over the next few, let's say couple of quarters, we are keeping our hands off gold as a segment, gold jewelry as a segment. We are playing the other pockets where there is probably better evidence to build a case for better performance. For example, staples we feel should do relatively better off. Retail and apparels should do relatively better off because rural incomes seem to have seen the worst, and real wages are beginning to move up, and so is inflationary expectation beginning to top out. These are RBI surveys, so we give it better authenticity. So our sense is that some of these discretionary sort of plays will probably have a better performance and better environment to play around. Remember, last 2 years, rural has been taken a big dent because of high inflation in 22 and then bad monsoon in 23. And there's a lot of hopefully a pent-up demand once the cash flows start improving because of real wages and also because of the better monsoon that we're witnessing. So hopefully over the next few quarters, you will see a better wallet spending on the rural side, and that will have its own positive impact on some of these categories, which we feel more confident about.
Amit, the big change in the last 1 week or fortnight has been the rise in crude prices. I think crude prices have inched up 6-7% in a span of 1 month. What does this mean for oil marketing companies? I know you're negative on oil marketing countries. It's not, none of them feature in your top picks. But what's the construct looking now, and what do you like in the energy basket?
So we're playing more of the CNG story. It's been a contrarian call, and I think that has been largely led by one of the valuations are extremely attractive. Some of these franchises have free cash flow yields at 5% plus, dividend yields at around 4.5%, and valuations that built in too much of pessimism because of this EV theme, capturing the overall market share. One doesn't deny the fact that there will be some dent on some of the categories on the auto space because of transition to EV. But I think the larger narrative for India still continues to be pretty supportive of CNG as a space. So versus the OMCs, which we did play last year, wherein the pricing environment was far more supportive, and there was obviously much better profitability from some of these franchises. We are avoiding the OMCs at this stage. But it doesn't get triggered by the near-term price variation on the crude side. I think it's one-off. I don't think it is structural. And if it does tend to be structural and let's say a 3-digit read on the crude prices will definitely have a negative impact on the OMCs. But our take is more driven by the fact that they have seen their peak profitability, peak margins. And from here onwards, we find the risk-reward much better aligned for CNG as a segment to play on the energy basket.
Thank you very much for that. We will slip into a very short break. We'll come back and talk more about banks. HDFC Bank is the biggest loser today. On the other side, we'll invite Nitin Agrawal from Motilal Oswal Financial Services. Stay tuned.